All right, let's talk about gold. Now, on the event of Akshaya Tritiya, usually thousands, tens of thousands of Indians go out to buy gold. There's a significance to it. And we're going to talk about not just the significance of buying gold on these occasions, but we're also going to talk about the significance of gold in your portfolio from the perspective of personal finances. Harsh Roongta is joining me to talk about this. Harsh, let's talk about why this is. Because for years unending, years uncounted, you've had Indians go out and buy gold on these very auspicious days in the calendar. Akshaya Tritiya, you also have during Diwali that people go out and buy gold. My question is why? Why is it that people buy gold?
So I think like a lot of other things that we do, in the good old days, a lot of custom, etc., was built with a religious garb. I mean, take the simple example of pilgrimages, right? I mean, normally in your day-to-day life, there was no concept of a holiday. So pilgrimages, because it was garbed with a, with a religious or a requirement, it sort of became the holiday that you took. And which was needed. You needed a change of scenario. I think something similar. Please remember during, say, 50, 70, 80 years ago, a normal middle class person or a not so middle class person would hardly save money to invest. And gold was the only form of investment that allowed retail investments. Land or cattle, etc., which would be the other forms, they're just too bulky. So gold was the only retail investment, and therefore this social mode of buying it on certain auspicious occasion came into being, so that there was forced investment. Just like we say a systematic investment plan is a great way to do forced investment because it takes the money out before you spend it. This was a way to do forced investment. I suspect that is probably the reason the whole
that is actually a very good suspicion, I should say, because this is something that makes a lot of sense. But in that context, I also want to talk about the nature of gold. And perhaps the reason why it was considered such a good investment is because it is so fungible. It is universally acceptable as a store of value, but also talk about the significance in a portfolio. Why is it looked at as something that beats inflation? Why is it looked at as something that is a safe haven?
In many ways, gold is an asset because everyone thinks it is an asset. Okay, and everyone has thought it is an asset since since millenniums. Okay. So I think that is one part. But if you look at it as an investment, then you just need to look at the three parameters that that you should use while evaluating any investment: risk, return, and liquidity. Clearly, because of the widespread acceptance of gold, liquidity is literally at midnight you can encash gold, physical gold, I meant. Okay, liquidity is superb. So there is no question of, having issues with liquidity. As far as return is concerned and volatility, risk, the chance that the price will go up or down, I think it is like domestic equity. It is quite volatile, very unlike what people think. Over short periods, gold can be very volatile, almost as volatile. It's slightly less volatile than equity, depending on which way you look at it, but it's definitely less volatile. But then it gives lower returns than equity, slightly lower returns than equity as well. But that too over long periods. And when I mean long periods, we are talking 8 to 10 years. So if somebody expects that, inflation is going up, let me invest and, gold will go up at least to the rate of inflation even after a year, I think he or she should disabuse themselves of this hope, because it might not be met. But over long run, I think all volatile assets, they would need to give good returns. Otherwise, why would anybody take that volatility? So whether it is gold, whether it is domestic equity, whether it is international equity, all of them would give good returns in the long run over 8 or 10 years. But in the short run, they can, the prices can go up and down quite a lot.
You were speaking earlier and you mentioned that the standard deviation of gold is less than equity, but it is still volatile. I do want to ask about the investment into gold, and people are treating this as an investment, right? So the question really, and this is in a previous conversation that I had also, the person I spoke to said that in India you have this intermingling of investment and consumption. You buy jewelry thinking, okay, I'm investing. If at some point of time I need the money, I will liquidate this and I will take the money. But I don't think you ever end up selling jewelry that you buy, right? It's the last ditch option that you have. So what should the approach be for investments into gold?
So as I said, if you're talking jewelry, okay, then even I don't treat it as an asset, because anything that loses like 25% value moment you buy it, okay, really can't be an asset, okay. But as an investment asset, I think it should be there in every investment basket. And I think what that percentage should be will depend on what that investment basket is constructed for. As long as the usage of that basket is long term, 8 to 10 years or more, then gold should be a part of such a basket. That is my view. The percentage could vary. It could be 5%, it could be 10%. Somebody who's dead set against gold also ought to have at least 2-3%. That is, my view. It should be built systematically. I think that is very important. Any volatile asset, be it gold, be it equity, be it international equity, needs to be built systematically and not, built on a, don't buy it, oh, prices have come down, let me buy. Trying to time a very volatile asset normally does not pay off. Sometimes it does pay off, but that gives rise to, this thinking, oh, I know how to do this. And then next time it does not pay off.
And I want to stretch the point that you made about the forced investment every year, right? Because these occasions present you an opportunity to buy. This is a good approach then, right? If you think about it, you're not really timing the market. You're buying gold irrespective of where the prices are. So in a sense, that's the right approach to have.
Yes, except that it becomes a yearly approach. I would say that a systematic approach would typically have slightly lower periods, okay? Because, because it is traditionally bought at this time, whatever be the trend, it tends to price tends to shoot up above that trend on the days surrounding a traditional buying day. So why would you want to buy when the prices are high? If you want to do it systematically, use the SIP route. It's worked beautifully in domestic equities, international equities. Use the same route, invest it in a gold fund, okay? Buy it systematically every month, preferably every month. I would prefer monthly, but you're right, it can be yearly, though I suspect the smoothing will not be as much as it would happen in a monthly systematic buy.
I know that you're averse to thumb rules, and I still want to ask you this question, which is in terms of the ideal allocation, and you mentioned that everybody should have some allocation towards gold. So how should you plan it, depending on whether you like the yellow metal or not, of course, and what form should you buy it on?
So I think the best form of gold, at least in India, that you can buy is as a way of a financial asset, not physical. Okay, because it suffers from a lot of taxation, and the best non-financial asset around today is sovereign gold bond. The only issue is it's not very convenient to buy. It is not amenable to a systematic purchase. So what we have recommended to people is that they purchase it systematically, they sort of invest it systematically in a gold fund, and then buy, once the accumulation becomes at a certain size, then they, redeem it and buy a sovereign gold bond. That is what we recommend. Just remember, sovereign gold bonds, as long as you don't need the sovereign gold bonds, are not as liquid as physical gold or as a gold fund. When you go to sell, you may get a price that's much lower than the market price of gold, but that's an advantage, right? If you don't need the liquidity, if you are really looking for a 8-10 year investment, a gold bond, a sovereign gold bond is an 8-year investment. You're not looking for liquidity, you're getting gold at a discount. Remember, you will get paid in the end at the then prevailing market rate. What is good about it is that whatever gains you make on redemption are tax free. Plus, instead of paying safekeeping, insurance charges, worrying about the safety, you are actually getting paid 2.5%. Even after tax, that's a good 1.5% or 1.75% interest. So your best way is to invest systematically through a gold fund, and from time to time sweep it into a sovereign gold bond. And if you can't take the trouble of buying it on the exchange at a discount, because it's not that easy to do, then you can still sort of buy it when a issue comes from the government.
That is done periodically by the Reserve Bank of India. And thank you so much for joining in, for giving us the perspective that you did give. 5 to 10% is what you'd said out of an overall portfolio, and at least 2 or 3% if I'm quoting you correctly. Thank you so much, Harsh, for taking the time. Pleasure speaking with you.
Thank you. Thanks, Alex.